This is the last unit of this course, and we will be starting with the Mundell model. The Mundell model is also called the Mundell-Fleming model. These were two economists who together came up with this model, and this model has a lot to do with the ISLM model, which we had done in one of the previous units. It is based on the assumption of a fixed price level and shows the interaction between the goods market and the money market, where IS was the goods market, if you remember, and LM was the money market. This model explains the causes of short-run fluctuations in aggregate income, or what comes to the same thing, shifts in the AD curve. So it is talking about short-run shifts in the AD curve in an open economy. It is based on a very restrictive assumption. It considers a small open economy with perfect capital mobility. So if you have understood this, you will be able to gauge the assumptions of this model as well, which I will be discussing shortly. This means that the economy can borrow or lend freely from the international capital markets. Because you see, open economy, small open economy. This means that it is working or it works in the open market and it can freely borrow or lend from international capital markets at the prevailing rate of interest. Since its domestic rate of interest is determined by the world rate of interest. So the rate of interest is not a policy variable in the small economy being studied. Why? Because the interest rate of this small economy is dependent upon the interest rate of the world. So the two assumptions are that domestic interest rate, which will be called R in this model, is equal to the world rate of interest, which is R star. So R will be equal to R star. And the second assumption is that we are considering a small economy which is open with the rest of the world and has perfect capital mobility. This open means that it trades with the rest of the world or can borrow and lend from the international capital market. Small means that its prices can be affected by the rest of the world, and it itself, the economy itself, doesn't have the power to affect the prices of the other countries. Perfect capital mobility, that capital can move in and out of this country with respect to rest of the world. Fiscal monetary policy for internal and external balance. Now, before we move further, let me talk about internal balance and external balance. Every economy has two balances. Internal balance is when internally the AD is equal to AS for an economy, that is the internal balance. And external balance, that is when the balance of payments is in equilibrium, that is the external balance. So we are trying to discuss this model for internal and external balance. Mundell has discussed the relation between two instruments and two goals. So, two goals or targets. You know that what are the two instruments? We have studied them, monetary policy and fiscal policy. Monetary policy, how do we express it? We express it through the interest rate. And fiscal policy, how do we express it? It is either through government expenditure or taxation. And what are the two targets of any economy? Any economy. The main two targets are to achieve full employment and to have balance of payment equilibrium. So that means internal balance is full employment and external balance is balance of payment equilibrium. Allotment rule of monetary policy for the objective of external balance and for internal balance is doing of fiscal policy. So we have to allot these two instruments to achieve these two targets. Once again, internal balance is full employment, external balance is BOP equilibrium. What are the two instruments? They are monetary policy and fiscal policy. Monetary policy is exercised how? Through the interest rate. Fiscal policy is exercised how? Through the government expenditure or taxation. Now let's look further. Now this is the model. In this figure, on the horizontal axis, we have the interest rate, and on the vertical axis, we have budget surplus, okay, or savings, which is the fiscal policy. FF is the internal balance line, XX is the external balance line. As you can see, this is FF, your internal balance line. This is XX, your external balance line. Okay. Line FF expresses full employment. Its slope is negative because of maintaining full employment cut in the savings budget has to be definitely balanced by increase in interest rate. because there is an inverse relationship between interest rate and budget surplus to maintain the full employment level. Therefore, this line FF is negatively sloped. Inflation is below this line FF in zone 3 and 4. Now we have various zones here. This is the first one, second, third, and fourth, right? These are the zones. So in zone 3 and 4, you can see that inflation is below this line and it is above it in zone 1 and 2. It is above it. So that shows recession. On the other side, line XX, this line, gives all the points of balance in balance of payment. This line is showing, because it is showing external balance, it is showing BOP equilibrium. Its slope is also negative because by cutting savings budget, imports increase. For stopping which it is necessary to improve capital account by increasing the interest rate. Below this line in zone 1 and 4, there is a loss in balance of payment, and above this line there is surplus. So below this line there is deficit and above this line there is surplus. Like below this line there is inflation and above this line there is recession. In comparison to line FF, slope of XX is much straight because when interest rate increases for balancing the expanding fiscal policy, it motivates an undercurrent flow of short-term capital for external balance towards interest rate changes. As much relative will be capital momentums, that much more will be line FF and XX of the straight slope. By this, monetary policy becomes comparatively more effective and in maintaining external balance. This figure shows the internal and external balance and tells that in maintaining balance between these two, what job or what role monetary and fiscal policy actually have. Assume that in zone 1, economy is at point A here, okay, where there is full employment in the economy and deficit in balance of payment. So here we had talked about that this was a full employment level, and before this is equilibrium. So this is full employment situation. For ending the deficit in balance of payment, monetary officer first makes an increase of AB in interest rate. So it goes from this point to this point, AB in interest rates, so that the supply of money may be reduced. By reducing the money supply, demand for goods will decrease, and by it, imports will decrease also. Further, and at point B, balance will be established at balance of payments. Now we know that this line is showing balance of payments. So when we are going from point A to B here, we are achieving balance of payment. At this point, there will be recession and unemployment in the economy. For correcting it and for bringing internal balance, reduction in the amount BC will have to be done. So we reduce it from point B to C. And just like we went from A to B, we'll go to D, then we'll reduce it again, then we will continue this process until we reach point A, where there is external balance and internal balance together at the same time. At D, now we have at point D, internal balance is again disturbed, because of which there is further cut in the savings budget. After decrease of money supply, by this process of decrease in savings, the economy reaches at point E, where there is internal external balance. You can study the first, second, third zones from these key. There are some criticisms of this model. Firstly, that it takes some unrealistic assumptions. This model assumes that officers know the limit at which economy is far from both the internal and external balance, so that appropriate monetary and fiscal policies may be used. This is also assumed beforehand that they know quantitative results which are possible by use of each policy. But these assumptions are far from reality because it is not possible to correctly judge the category of imbalance. Hence, changing the policy may not be appropriate for such type of imbalance. Second, overlook of unemployment and inflation. This analysis overlooks unemployment and inflation. It is unreal because this concept which is known by the name of stagflation, is often found in all developed economies as well. Third, neglect of other factors. This analysis only thinks over difference in interest rates, a reason for capital momentum, and ignores other factors such as exchange rate changes. Other than this, it is not possible that continuous deficit is financed by capital momentum. Fourth, practical constraints of monetary and fiscal policies. Monetary and fiscal policies work under a definite practical constraints of political reasons. Some governments are not able to follow restrictive fiscal policy and monetary policy with high interest rates. Though such policies may be started, but they cannot be successful because capital flow cannot be interest sensitive. Fifth, unsuccessful prescribed policy mix. Prescribed policy mix cannot be successful in correcting current account deficit because policy mix influences both the capital flow and the imports. That is why it only ensures that negative business balance is compensated by positive capital flow and also vice versa. Sixth, not true adjustment mechanism. Monetary fiscal mixture is not a true adjustment mechanism. It just does not adjust balance of payment, but only makes it stable. Capital flow, leaving the prices and income unchanged, only completes the gap between the sovereign demand and supply of foreign exchange. Seventh, no consideration on debt servicing requirements. This analysis does not make considerations on debt servicing requirements because when domestic interest rates are increased, then continuous capital flow will happen on the current account of balance of payment. 8. Decrease in investments at home. When interest rates are increased by the medium of monetary policy, it will bring a decrease in domestic investment. It also it should definitely be accompanied by either a decline in government expenditure or tax cut or by compensation of the two. Such monetary fiscal policy mixture misuses the savings of the economy by turning them into debt financed government expenditure, which stops the capital building. According to Johnson, it creates the problem of impetuosity versus proficiency in use of domestic savings possibility. Ninth, conflicts between prescribed policy mixes. This is a possibility of inter-conflict between the prescribed policy mix of governments of various countries. Johnson has said in all countries together reach the right combination of monetary and fiscal policies, particularly if adjustment of policies is done by examining and defects relating to order, then it will be a complex process. Under some circumstances, instead of taking in the direction of balance, it may take far from it. With this, we complete the Mundell's model. Now we will be discussing the Swan model. Harry G. Johansson has advocated the policies of expenditure changing and expenditure switching for adjusting the internal demand and to effect a balance in external account. The impact of such policies on the balance of payments and the level of employment has been analyzed by Trevor Swan. The simultaneous existence of internal and external disequilibria has been shown by Swan through this figure. Policies for internal-external balance, expenditure switching and expenditure reducing. These are the two policies, expenditure switching and expenditure reducing. The simultaneous existence of internal and external disequilibria has been shown by Swan through this figure. As you can see, this is the two curves. Again, it has been divided into zones. On the x-axis, we have real expenditure. On the y-axis, we have cost ratio. International prices divided by the domestic prices. As we saw earlier that the vertical scale shows the cost ratio and the horizontal shows the real expenditure. This cost ratio is the ratio of international prices to the domestic prices or to domestic wages. The internal balance curve slopes downward from left to right. as you can see, internal balance curve is flowing downward from left to right. It indicates that lower the cost ratio, which limits exports and import substituting production, the higher must be the real expenditure to maintain the full employment. Positions to the right and above the curve represent the inflation, with domestic real expenditure excessively high relatively to exports and import substituting production. Below and to the left of the curve, there is unemployment. So below there is unemployment and above the curve there is inflation. Another curve represents the external balance. So this curve is which is showing the external balance, which is X minus M, exports minus imports. Below of this curve you can see this is the deficit situation, this is the surplus situation, and above is the surplus. So again, this diagram is also divided into 4 zones with inflation and balance of payment surplus in zone 2, right? Uh, Inflation and deficit in 3, unemployment and deficit, and 4 with unemployment and balance of payment surplus. So this is 4, surplus and inflation in 1, inflation and deficit in 2, deficit and unemployment in 3. According to this diagram, you can see that the equilibrium, total equilibrium, can exist only at one point where this curve and this curve, so the internal balance and external balance, intersect each other, right? The complete equilibrium occurs only at one point where the two curves intersect each other. In zone 2 and 4, that means in zone 2 and 4, where the internal inflation and external deficit and unemployment and external surplus respectively coexist, the movement towards equilibrium can be achieved through expenditure changing policies. So in these two cases, when we are to move towards the equilibrium, we will use expenditure changing policies. And in zone 2, a contraction, and in zone 4, an expansion in real expenditure will help to restore the balance. So in zone 2, if there is contraction, and in zone 4, if there is expansion, here if we contract and here we move outwards or we expand, we will come to the balance. In zone 1 and 3, there is coincidence of surplus and inflation, and surplus and inflation in zone 1 can you see, and in the third one we have unemployment and deficit respectively. The alteration in the cost ratio through expenditure switching. So the difference is that in these two zones, 2 and 4, we were using expenditure changing, and in 1 and 3, we will be using expenditure switching policies like exchange, depreciation, appreciation are likely to bring the system in a state of balance. The expenditure changing policies can be split up into monetary and fiscal policy. The fiscal policy, which can be represented by the national budget, whether deficit or surplus, can have its effect upon both internal and external balance. The monetary policy can influence the balance in two ways. Let's look further. Firstly, the variations in the interest rate affect the business investment, which through multiplier affect also the consumption spending. Secondly, the interest variations cause movements in the short-term capital and can thus influence the balance of payment situation in the country. The use of monetary and fiscal policy for the achievement of internal-external balance can be depicted using this diagram, right? Here the two curves represent internal and external balance again. Here this is the internal balance and this curve shows the external balance. Okay. This is similar to that of the previous diagram. Again we have 4 zones, 1, 2, 3 and 4. The steeper slope of the external balance curve indicates that it is more responsive to monetary policy, while the internal balance curve is more responsive to fiscal policy. Of course, this is internal balance responsive to fiscal policy, external balance responsive to monetary policy. These curves have been drawn on the basis of a given cost ratio of domestic and international prices. We have the prices, and according to those prices, these curves are prepared. A change in the cost ratio will cause a displacement of both the curves. An increase in the cost ratio would shift the external balance curve to, now if the cost ratio shifts, it will move rightward or outward. It will mean that a higher interest rate, given the budgetary surplus or deficit, will be required for the achievement of balance. Such a change in the cost ratio will shift the internal balance curve downward, this one, to the left. It shows that a reduction in the spending on exports and import substitutes requires a higher budgetary deficit at a given rate of interest in order to maintain full employment. So this model takes some assumptions that trade restrictions do not exist. There is free trade in the economy. Capitalists do not exist, and productivity, terms of trade, and other financial transfers are given. Now let's look at the policy measures. For description of policy measures which are important for simultaneously obtaining internal and external balance, we will take it in 8 possible conditions of imbalance in the figure above. So there are 8 possible conditions of imbalance. For these conditions, various combinations of policy measures are important. Many countries are in equilibrium at point A. So let's take this point A of the curve XX in payment balance and unemployment or recession, right? For such a situation, there is need for extension of domestic economy through increase in domestic expenses. It will reduce net exports. For making this tendency ineffective, devaluation should be added to increase in domestic expenditure. If deficit moves along the unemployment and payment balance, as happens in zone 3 at point K, this is zone 3 point K, then there should be an increase in domestic expenditure. Policy is increasing internal demand by the medium of expansive measures also increase domestic employment. But this policy increases the deficit in balance of payment. It is described in the form of a dilemma zone because instead of expansive policy, devaluation is the preferred one. In balance of payments, if the economy adds full employment with deficit, as happens at point D of curve FF, point D of this curve, the FF dash, the devaluation is its only solution. This huge predefined will create surplus and extra foreign demand will bring inflation in domestic economy. For stopping these tendencies, little devaluation will have to be added to cut in domestic expenditure. Take point H in zone 4. Zone 4 point H, which is inflation deficit zone. Inflation should be stopped by a cut in domestic expenditure, which also reduces deficit and balance of payment, and finally will take the economy towards a balanced situation, which is point E here. If there is equilibrium of balance of payment and inflation, as on point B, now look at point B here on curve XX dash, then it should increase its rate of exchange and reduce the domestic expenditure. Take point G in zone 1 where surplus in balance of payments is added to inflation. In such a situation, for correcting the surplus of balance of payment, exchange rate should be increased and for stopping inflation, expenditure should be reduced. But cut in expenditure will increase the surplus. It again expresses a dilemma zone. If the country is in the situation of full employment and excess imbalance, Swan model of payment at point C of the curve FF, then it should increase its rate of exchange. But increase in rate of exchange will create unemployment. In order to be saved from it, domestic expense must also be increased. At the end, let's move to point F of zone 2. Zone 2 point F, where surplus in balance of payments is added to unemployment. You see surplus and unemployment. Here increase in domestic expenditure will be appropriate for both internal and external balance. Such a policy will increase employment and for reducing the size of surplus will also induce increase in imports. Above mentioned analysis presents that if economy is neither at the curve FF, which is internal balance, nor at xx, which is external balance, then it is in any one of the four zones. If we are not lying on any of those points, we are lying between these lines. That means we are either lying in zone 1, 2, 3 or 4. When for achieving one objective, say internal balance, economy follows only one policy or both expenditure switching and reducing domestic expenditure policies together, then it moves from the other objective, say the external balance. This problem arises not only in the dilemma zones 1 and 3 but also in uncomplicated areas 2 and 4. 1 and 3 are our dilemma zones. For example, if we take point F in zone 2, this point, which is, and in zone 2, what do we have? We have surplus and unemployment. Where surplus in balance of payments is added to unemployment, then expensive policy will reduce unemployment and will also reduce surplus. But for taking the economy to full equilibrium, point E, then price increases or price decrease of exchange rate will have to be accepted, which will remove the economy from one objective or the other objective. So we will have to let go of one objective or the other.